Hello and welcome to the Monday Futures Market Outlook for July 29th, 2013. This is Patrick Sresna. As always, we start off with a chart of the euro as it trades against the US dollar, and we can see that obviously a short-term low has been put in at this 128 level down below. We've now seen the euro continue to proceed toward the highs of June, which lie in this 133, 134 zone right above over here. And while we see no evidence that an immediate reversal is starting, we're starting to approach some of those levels where the euro will struggle along the top side. That doesn't make it a reversal imminent, but if we do find overhead resistance somewhere in this 133, 134 level, there's nothing stopping the euro from piercing deep back into the bottom end of this range. So we could easily see volatility within 300-400 pips, both down and even a few hundred pips higher, with no immediate trend in place that is dominant. So we remain relatively neutral in the much bigger picture. We think there is room for the euro to deteriorate, but there's no evidence that a downtrend has begun. Next year, when we take a look at some of these commodities, we can see that copper continues to deteriorate. This is now a poor little wedging formation that is deteriorating, which makes copper relatively vulnerable. While there's no certainties, we can say that this type of price action does favor further deterioration. If we see any momentum build on the downside of copper here, we could see lows as low as 290, even 275 on the downside over the next couple months into August and September. Again, while that move hasn't really begun, the price action that we're seeing here over the last month is relatively weak, and there's no evidence of an immediate trend reversal. Next year, I want to take a look at crude oil, and this is where has been the strongest commodity to date, and it's done very, very well. But in the last week, we've seen those short-term highs come in, and a little bit of price deterioration off the 108, 109 levels up above. At this juncture, this consolidation can even lose another further $2 to $5 on the downside, but it would remain relatively bullish, even if we saw $3 to $5 on the downside, so long as the $100 level holds old consolidations. There's plenty of room for oil to take still yet another stab back at the highs, if not even making higher highs. And so really at this stage, it's about whether or not a buyer on dip emerges here, and where would it go once that triggered a buy. At this stage, the only point from which we would change our perspective would be any price action deterioration that accelerated below $100 very rapidly. At that moment, we would start to reconsider some of the alternative outcomes of crude oil that could come to the bottom end of its range. Next year, I want to take a look at gold, and gold has been strengthening off of that $1,200 low up to the $1,350 overhead resistance. This is where we are looking for the price action to tell us what's in store on the most immediate future. If gold is able to one degree or another exceed $1,350 with any momentum, it would almost certainly solidify an end to the current downtrend that's been in place for almost a year now. And at the same time, even if the gold was to break down off this overhead resistance and not make a lower low and establish a base, that also would mean later in August going into September there could be a bottom as well in place. At this stage, there's a lot of scenarios where we could build a more bullish case for gold, but at this stage I'd be hard pressed to want to be bullish just yet. There's not enough evidence yet, but I'm certain that over the next 2-3 weeks, when we see how the price action consolidates and establishes itself, we'll be able to make a much more definitive call as to whether gold is going to become more bullish. Next year, I want to take a look at the 10-year Treasury bond, and the Treasury bond has been bouncing, but there's nothing outright bullish about this pattern yet, or nor is it almost immediately bearish. At this stage, we know that low that occurred down over here was meaningful, but in many cases, those kind of bottoms usually have a retest. There's nothing stopping the Treasuries from still yet again dropping a full handle or lower on the downside to solidify identify a bottom or to bang out where that support is, and then use that foundation to retrace all the way back up to this 129 level up above. We don't think that this is necessarily bullish bonds, but rather simply that the sell-off in bonds was fully priced in, and at this stage, bonds will need to find a median level somewhere in between, and we think that a test of 129 over the next month or two is quite probable. Finally, I want to take a look at the S&P 500, and here the market has continued to consolidate just below the 1700 level. We think that the S&P can take a couple stabs still, even for pushing to the upside, but it is very likely that overhead resistance will be very dominant up here, and that the risk-reward proposition of the market is very poor. Now, even if the stock market doesn't crash or go through some very deep correction, at minimum, this will be the top end of a consolidation range where the market will likely gravitate back to the bottom of the range and then back to the top. And we may theoretically, come September, be no further ahead than where we are today. And that's so from that perspective, we don't see very much value in remaining in equities without there being a continuous consolidation, especially for those that are not long-term buy and hold investors. This is certainly a prudent time to be trimming positions as well as putting in some hedges along the way. Even if the market temporarily does break to 1720 in a very quick 30 S&P point swing, it probably will just be an opportunity to distribute into some of that strength. That was your Monday Futures Market Outlook. Thank you for joining me.